You're about to join Niels Kaastrup-Larsen on a raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Series.
Welcome back to this week's edition of the Systematic Investor Series with Mark Rzepczynsky and I, Niels Kaastrup-Larsen, where each week we take the pulse of the global markets through the lens of a rules-based investor. Now, for those of you who are regular listeners, this podcast series is all about voicing our differences on the one topic that brings us together, namely systematic investing, using the often overlooked and very robust strategy of trend following. We hope that today's episode will trigger your curiosity to learn more by diving into the back catalog and listen to all of the past episodes that you may have missed, like last week's episode with Alan, where we unpacked ways to use trend following as part of a risk mitigation subset of a portfolio, as well as how you can approach building an alternative investment portfolio and much more. Also, I would encourage you to listen to our Wednesday episode, where this week I caught up with two of the most popular global macro thinkers, namely Macro Alf and our own Jem Kazan, where they had a solid discussion about how they see the current state of affairs, somewhat differently, I might add, when it comes to the future path of inflation and interest rates, but they also found a few places of agreement. So head over and check it out after you are done listening to Mark and me today. Mark, it's great to be back with you after another week where more Fed action and important economic data has been released. But before we dive into all of this, how are you doing? How are things where you are?
Good. Always good to talk to you. It's been about 6 weeks since the last time we were on together.
And something always happens in between, Mark, but there we are. Now, Mark, I have to ask you a personal question, and that is, are you familiar with the TV series called Ted Lasso?
Yes, I am.
Well, then you know that in it, Ted Lasso encourages his football players to be a goldfish because the animal only has a 10-second memory. And this week's events may suggest that the Fed is actually taking this advice literally because, to some people's surprise, this week was really not about the Fed hiking rates. Let me explain. The most consequential story of this week came out on Tuesday, the day before the FOMC announcement. The Treasury Buyers Advisory Committee, TBAC, released the minutes of their quarterly meeting with the Treasury Department. The TBAC is a high-level group of money center banks and Treasury bond buyers that meets with Treasury officials quarterly to discuss operations of the Treasury bond market. The Treasury asked the TBAC what the tolerance would be for Treasury buying back bonds in the open market. And I'm thinking, what? I mean, the current environment in which we find ourselves can be laid mostly, if not entirely, at the foot of the Federal Reserve and the irresponsible monetary policy that it has pursued. That they even consider resuming market manipulation is incredible, but perhaps it's not surprising. Most likely, the Treasury and the Fed realize that they don't want to take interest rates back to zero again, but they need a plan on how to stimulate the economy when it slips into recession, which could come as early as later this year. Of course, the TBAC gang, salivating over the potential for even greater trading profits, wholeheartedly welcomed the plan. At this time, the buyback plan is only an idea, but we may find out that this is an idea that will come to pass maybe as soon as later this year. Aside from the TBAC minutes, there were plenty of lift volatility this week, and it was no surprise that JP Morgan rode to the rescue and bought the troubled First Republic Bank. On Monday, Treasury Secretary Yellen publicly announced that the US banking system is sound, and in an attempt to calm nerves and fears that the fate of First Republic is not going to prove contagious. The Fed, as was widely expected, raised the overnight interest rate by 25 basis points, and the accompanying statement was worded to sound neutral, not too hawkish, not too dovish. At the post-FOMC press conference, Chairman Powell reiterated Yellen's assurance that the US banking system is sound. The press conference started out as usual softball fest of Q&A until CNBC's senior correspondent Steve Leisman asked Powell about his response when he was informed in February that Silicon Valley Bank and several other banks were sitting with hold-to-maturity portfolios that were substantially in the red. Powell responded, and I quote, It wasn't presented as an urgent or alarming situation. It was presented as an informational, non-decisional kind of thing. Leisman responded, I'm sorry, I don't mean to sound argumentative, but the staff report said SVB had significant interest rate risk. It said interest rate risk measures failed at SVB, and it said banks with large unrealized losses faced significant safety and soundness risk. Was that not alarming? Powell's response was basically what has become known as word salad, a response that neither answers the questions nor makes much sense. The chairman was clearly frazzled and quickly moved to some other questions, mostly focusing on if, when, another rate hike would be engineered, and mostly reiterating that the US banking system is sound. Judging by the performance of the regional bank ETF, down over 40% since March 1st this year, investors aren't really buying that. Finally, we had the employment report, usually the most watched economic data point of the month, but almost an afterthought during a week such as this. Economists had been forecasting a deceleration in hiring from the 236,000 jobs gained last month to about 185,000 this month. Instead, the economy added 253,000 new jobs, and the unemployment rate fell to 3.4%, matching the all-time low reached in January of this year. However, that 236,000 registered last month was revised to a gain of 165,000. The takeaway is that despite the Fed's attempt to slow the economy, there remains a worker shortage and job growth remains pretty healthy. All right, Mark, that was a long introduction. Let me bring you in here just to touch on some of the things that have caught your attention. I don't know if you even were thinking about the TBAC before I mention it, but what a week.
So I followed the TBAC for a long time, and because I was doing some work for the government, this is back in the 80s, of monitoring the government primary securities dealers, and what was their risk profile. This was an area that I focused in on my academic research, and so I've been following for a long time, and they really do focus on liquidity issues, and then these longer term macro issues, but a lot of it never gets a lot of press coverage. The one thing I could sort of say overall about the events of the last week and last month is the phrase that I heard that is applicable to how you look at markets and how you should think about it. One is that it's not that is what is unforeseen, but what is unaddressed. That's the issue that we often face. So you look at the debt ceiling, okay? It's not that we don't know it's coming. We knew it was coming a year ago. It's the fact that it's been unaddressed. And so now it's going to become a problem until the last possible minute. There's no reason why people couldn't come together and sort of address this issue right now or last month or a quarter ago. You look at the banking crisis. It's not that it was unforeseen. If you know that you're raising rates after keeping rates at zero for a very long time, and you saw banks start to buy treasuries in their portfolio, you know that they're going to be holding losses. Now, we could hide some of this with the accounting gimmickry, but at the same time, is that it's not going away. And all this, and then you look at, let's say, the big issue about credit and the credit cycle, is that we're going to see that credit is going to be tighter. And it's not, we know it's going to happen. The question is whether it's going to be addressed. Overall, what does this mean for those people who are quantitative, systematic trend followers? The issue is that markets are driven by inertia. When you have inertia, this is that there could be trends. Okay, there's inertia in response to crises. There's inertia in policy responses, and when you have this inertia, what will occur is that prices are going to move slower than what we expect. Perfect example is credit. This is that if we reduce the amount of credit or credit becomes tighter, credit as always can be thought of as a lubricant into the financial markets and in the real economy. And if, let's say, we don't have enough oil in the engine, or we don't have enough lubrication in the engine, things are going to start to slow down, and we're going to sort of see the inertia. The sand is going to be in the engine, and then that's going to have an impact on prices. And think about where the trends are going to come from. You could have it in commodities, because if you don't have financing available, then prices are going to have to go up. You're going to see it in FX markets. If there's not enough credit available, then those that need credit are going to start to move away from those that have excess credit. And we know that the FX market is very much driven by the availability of credit. Fixed income markets, obviously, is that if you don't have enough credit, is that the cost of credit is going to go up in terms of what people are going to have to pay as spreads. And then finally, equity markets, is if the discount rate is going up or the price of credit is going up, that should have an impact on financial prices.
Yeah, no, absolutely. Good insight. All right. Well, in terms of trend following, just sort of this week, I would say probably not a great deal changed. I mean, we had a pretty strong recovery in April now that the numbers are out. I would say trend follows made back about a third to about 60% of what they lost in March. So, that's decent. But I would also say this week, or the first week of May, has kind of started off in a similar fashion, because most of the action we're seeing at the moment is really in the commodity side of the markets. And if you're on the right side of those, there are some good opportunities. This week, I noticed that there were some decent opportunities in prices or in markets like aluminum, lean hogs, and even the energy complex, which obviously came under renewed pressure. Let's put it that way. But there were other markets that most likely would have caused a little bit of losses here and there, like live cattle. We had wheat, soybean oil, cotton correcting a bit. And then the financial markets, not a lot. I mean, equities, were fine. Fixed income, probably small losses on that. And currencies, I say equities were fine. I mean, not a lot happened. They probably didn't make money, but not a lot happened. And then same with currencies, even despite the Mexican peso from a trend following perspective still behaving quite nicely. But I don't think there was much to gain from that either overall. So anyways, my own trend parameters completely stock in neutral at 45. Really no conviction either way. And it's been for that all year, really in neutral to weak zone. And that's obviously reflected in the performance, and even in the beginning of May, as of Thursday, we have the BTOP 50 index down about 1% for the month of May, down 3.25% for the year. SocGen CTA index down 81 basis points, down 4% for the year. Trend index down about 78 basis points, down 5.38% for the year. And the SG short-term traders index down 45 basis points, down 2.6% for the year. Equities doing fine so far this year, up 8.4% for MSCI World, 7.7% year to date for the S&P 500 index. And so far this month, the government bonds are completely flat. Now, Mark, we have a couple of things that we may come back to depending on how much time, because you brought along a long list of points that I want to get to first. So we may come back to a little bit about WTI and some recent action that Hal from TransTrend commented on, and also some Q1 sort of more broadly based asset class performance that I picked up. But you brought along a lot of points that I'm very interested in hearing your, where we're going to go with this. Because when I looked at the points, and I mentioned this to you before we pressed record, it looks like, on the surface at least, it's almost like the interchange between global macro and trend following. So I'm sure you're going to correct me if that is a wrong interpretation, but I'm just going to basically hand it over to you for a while now, I think, and then I'll maybe hopefully be able to add a few points along the way. But there is a structure in the way you've ordered this, so I better let you be the maestro at this stage.
Well, let's go back to what drives markets. And I think that this has been a recurring theme of the way I look about trends in markets in general, is that you say there has to be some stimulus or some underlying cause that causes trends. And so when we started our conversation, we talked a little bit about inertia. And so if there is a threat or if there's a cause and that cause is not addressed, that will create trends. Okay, so we know that that's the case. Whether it's the threat of a recession, it's threat of Fed policy that causes inertia and that displays in prices. Now, following this inertia in the physics analogy, which we're looking at, we'll call it, low-level physics is high-level math physics. This is just that. Well, what causes a trend to change? Well, it's some type of stimulus or some type of event that will cause that inertia to move in a different direction. Okay? And that's why you need to be aware of what's going on in the economy. And we spend a lot of time with my partners at Theme Analytics, like Andrew Bruner and my other partners, is that we spend a lot of time on change point detection. And so if you say that markets are driven or trends are driven by inertia, trends will stay in place as long as there's nothing to disturb it, then you do have to spend a lot of time on looking at what are the things that cause change and what's the likelihood of change. So now, trend followers have two different views on that. So, a simple trend follower will say, well, I don't look at any other factors. I just look at what the price is versus a moving average. And then my idea of change point detection is if the price goes back through the moving average, then I'll reverse my position. We'll say others might use other technical factors to say, has the market overextended as your change point? We think that there are other ways in which you could look at change points, and that's looking at different factors, either on a market specific or macro factors that might detect or give us some idea of whether there's a likelihood of change. And that could be on a sector basis, individual stocks or macro markets. And so that's where you sort of say separates you from other trend followers is how you deal with change and how do you address this issue of fighting inertia. Now, the way that we look at this or way I think about this, and I've been thinking about this for a long time, is that a good quantitative systematic manager should also be both macro and micro aware. And so you need to have micro and macro awareness. And so, well, what does that mean? This is it. Well, it's more than just reading the newspaper, albeit it's good to be aware of just what are the events that might be driving prices and driving markets. But awareness is just being able to say, do we know what are events that could lead to change? And how do we address those events or sort of deal with those periods of uncertainty? And let's take an example. This is it on macro awareness. Let's look at the FOMC committee meetings. This is it. I will sort of say that those are well-known dates. We know them well in advance. If you look at any kind of analysis, you find this is that there's what some people call a macro, announcement premium associated with the FOMC dates. This is that there's a good chance is that if you're moving in one direction, we have that price inertia. Is that FOMC comes out, Jay Powell says something, or the head of the ECB says something, take a guess, the market could move in a different direction. So one of the things that you might want to be aware of in your systematic trading, if you're macro aware, is just to say, how do I avoid these events? So maybe I shouldn't trade around those events, or maybe I should reduce risk if depending on my time horizon, when I see that these macro events occur. And the same with the employment numbers. We do know that there's a macroeconomic announcement premium. It may not be as strong as the FOMC, but it surrounds those events. And so one way to from a systematic way, is just take into account those specific macro events.
But can I interject here, Mark? I mean, that all sounds, completely common sense, that there are some events that we know can cause prices to move in a different direction. But, very often also it happens that the markets continue in the direction because whatever news is coming out is kind of confirmed. It's already, I mean, the markets or the trends are already in place. And you can certainly say that despite what the FOMC has done the past, year up until a few months ago, the bonds were, just heading south essentially for a whole year or more. The other point I just want to sort of mention is that, well, I mean, how can we as trend followers take this into account in reality? Because there's always economic data coming out, and we can't adjust our exposure, reduce it every other day just because there is a meeting. Because there's going to be a meeting somewhere in the world among the big central banks, or there's going to be an unemployment number somewhere in the world among the central banks. So, as I said, it all sounds like, that's a good idea, but the practical implementation of it, I struggle with, if I'm being frank here.
Oh, absolutely, and you should, because this is not easy work. So now let's look at and when we think about systematic investing, you also have to think about a spectrum of behavior. Okay, and the spectrum of behavior is determined by the level of complexity of your models, the input of data that you use, and what kind of reaction you'll have to specific events. So let's talk about the spectrum, and what I'm suggesting is that every systematic manager, or if you want to be a systematic trader, is that you have to then determine exactly where you want to be on the spectrum. Okay, simple. So one extreme on this spectrum would say, I'm going to look for trends in price, and I'm only going to use price information. I'm going to balance out my risks. I'll build my portfolio, but that's the only thing I'm going to do. I'm not going to take into account anything else. Like I say, is that I could read and in that case, macro awareness would be, I'm going to read the newspaper as an call it avocation. It's just sort of something I do, but it's not going to be incorporated in my model. Okay, that's one approach. Another approach, you can sort of say, well, if I'm a shorter term trader, macro awareness for change point detection is going to be very, very important. Okay, so my horizon will determine, and I guess say like, well, that in that case, this is if I'm looking at a very short term horizon as opposed to a long term trend follower, they say I have to be very macro aware. Okay, I have to look at these change points very closely. The other extreme is that if I just look price, the next level up in terms of we'll call it awareness and change point detection aware would be to say like, well, I'll use some technical indicators to say whether the market is overbought or oversold. Might sort of say like, look, I have some analysis that says that if the markets stretch at a certain level, that it's more likely that there's going to be a reversal, and I take into account that. Okay, that's the next level. And third would be to say, okay, I'm going to be aware of specific events and the behavior of markets, whether it's like I'm going to be very sensitive to on a micro awareness, what are the roles in futures? I'm going to be very aware about option expirations, for example. I'm going to be very aware about seasonality in markets. So let's say agricultural markets have a very strong seasonality, and I'm going to account for that. We'll call that micro awareness. Okay. So what I'm saying is that there's a level of complexity that you can add, and now your job is to sort of choose what the level of complexity you want to have in your models. Where do you want to be on the spectrum? Okay, do you want to believe that markets are just they follows this inertia and I'm only going to use price, or do I want to use other things? And we'll call it macro fundamentals might sort of say that, well, I want to take into account the shape of the yield curve, and that might have some influence on how I sort of position my trend following or what markets I might put added exposure to. So think in terms of the spectrum.
I think what the point you make about the short-term strategies, being aware of these events makes more sense to me. I think from a practical point of view, I think again, if you're a long-term trend follower and you've done your testing, or you are fortunate enough to have a long enough track record that goes back 30, 40, 50 years, your systems have quote unquote adapted to or are structured to cope with these events and change points, as you refer to it. Not to say that they won't be costly from time to time. I'm sure they will, but in the long run, at least we're able to cope. But I agree that maybe or in my view, for shorter term systems, I think that could be much more appropriate. Now, and again, I don't know where exactly we're going to go with this conversation, so I might be asking you a question now that you will come to later, but just bear that in mind. And that is, one of the things that you and I have observed from many, many decades in this industry is that, adding too much complexity in your systems often shows up at some point in a not so favorable fashion, and robustness comes from simplifying, which is also actually part of the most difficult part of what I think our research teams do, is to simplify things as much as possible, not oversimplified, of course. So how do you think about the balance between, yes, what you say about adding certain levels of complexity maybe, but yet still wanting to keep things as robust as possible? How do you think about that?
Well, let's first talk about the spectrum again in terms of systematic modeling. This is it, and I think you make the good point, and which I agree with 100%. The longer the trend model that you have, the less change points you're going to see, or the less, or in some sense, the less you're going to be influenced by change points. In some senses is that whether Chairman Powell speaks or not on a Wednesday on a very regular schedule is of no consequence to a long-term trend follower, because he's saying is that I built a model that's going to look through that event. In fact, he might sort of say that the debt ceiling is of no consequence. On the other hand, we'll say credit cycle might be of great consequence. The long-term trend in inflation might be a greater consequence in terms of macro events. Is that I'm looking at what has inflation peaked and is it coming down, and what's the speed in which inflation is coming down. So I can keep a model simpler when I look over a longer horizon, because I can sort of look through the daily events of what's going on. As I sort of push in and have a shorter term horizon, then there's going to be more change points that are likely. And I'm going to have to be more macro and micro aware the tighter I or the closer I'm looking in my strategy. So now, how do you actually sort of add, what's the level of complexity that you have? Is it you want to keep everything simple, but through testing, you can be able to sort of say a couple things. This is that when I add a new rule, what's the marginal contribution to return to risk? So if you want to say, I'm not saying Sharpe ratio is the only approach, but I sort of say, like, if I add this rule, what is the marginal contribution to Sharpe? But the important part is, what's the marginal contribution to Sharpe after I account for all the transactions costs that would be associated with that? So I could sort of, in back testing, I could sort of say, this was a great contribution. And now I can say, well, it's going to increase my trading by 20%. And I know that there's going to be the bid-ask spread that I pay, and I got to pay brokerage and other costs, of getting in and out. So sometimes, good awareness or sort of adding complexity might be, say, what do I do to not trade as opposed to trade? So I think that as an industry, we probably don't spend as much time on what are the cost of transactions, what's the cost of doing business when I build a model. So I can add a lot of features, but if I don't have a threshold of transactions costs, in reality, that may actually subtract from my performance between adding it. Okay, and part of it is also is that looking at doing the careful analysis of not using a specific statistical technique to analyze a market, but thinking about the sample or backtesting period that I have. So if I backtest a rule and it was only during periods when inflation was very stable, I could say, yeah, that may not be a good rule to add, because what happens if I have a more unstable inflationary environment? And I probably could sort of say from modeling this is that I could take one particular rule, I look at a back test over the last 3 years, and then I apply it to a period 10 years ago or 15 years ago when the environment was different. I could get very different answers.
Yeah, I mean, and again, not knowing exactly where we're going to go in this conversation, but when I hear people talking about adding other indicators other than price, I think price is just such a wonderful, pure way of analyzing things, because it takes into account everything, in my opinion, so to speak. Psychology of the market on that day and all of these things, positioning and whatever it might be. And I think once you move away from that, and let's just say, well, if having a rule saying, well, if the Fed hikes by 25 basis points, usually this happens. But as you and I have seen in the last few years, there's been so many examples of markets reacting in a way where you thought, that's really not what I expected, right? Like the simplest example was probably COVID, where you saw the whole world being shut down, and after a few weeks of losses, markets took off in a way that was just incredible. I really don't think anyone, very few, had imagined that. So how do we? How do we think about that in terms of adding these, additional features? But when they're not based on price, how can we be sure that their reaction pattern doesn't change along the way? Which I imagine most patterns change. Yeah.
Well, a lot of the indicators you're looking at is that you say, well, why do we love price? We love price because it's a weighted average of everybody's opinion in the marketplace. So if you have a choice on what other indicators that you want to look at, you want to say others that have maybe cross-market, that might give us some indication of what the market is thinking across markets. So shape of the yield curve, embedded expectations of inflation. The perfect example of where you run into trouble is that data that's collected by the government that's based on past information is subject to revisions. So a perfect example would be the unemployment number. So like the headline for this last Friday was really strong. And then you look at, well, wait a minute, let's look at the last 2-month revisions in the unemployment numbers. And you say like, well, what we added from the previous month, we subtracted by the revisions. Was that really a good employment number, or was it masked by the fact that there were revisions over the last 2 months? So I think that there's a view is that let's look at headlines that's coming from the government and let's extrapolate what that means. But if it's collected data that's subject to revision, that it may not always be a good indicator. So if you sort of say, what type of indicators I want to look at, I want to try to focus in on some transformation of prices, some transformation or some impact that is coming from other markets that might influence trends. So those are going to be more relevant than let's say, stats that are coming from the government that may be based on a look back at prior information and subject to revisions.
Yeah, no, absolutely. Where do you want to go next in your change point lecture?
Well, when you look at change points, we always talked about this idea of inertia, and so we just want to have the awareness of the fact that prices of trends represents inertia in markets, because there's a slow behavior, and there's slow behavior by government, slow reaction from investors, which creates inertia. Inertia creates price trends, and you say, well, what would cause that price trend to change? Well, it has to be some event or some change point that's going to occur. How do we sort of look at the likelihood of that? Now, one area that especially, let's talk about crisis a little bit, is that I'm always reminded of some of the work by Sherman Kent. And Sherman Kent used to, he was a Yale historian. He also was he worked for the CIA for a number of years, and he tried to make analysts better at what they do. And I want to go with two directions on this. One is that he always talked about when you talk about warnings and you talk about crisis, that there's always takes two to respond to a crisis. There's the warner, and then there's the warnee. There's the person who's giving you the warning, and then there's the warnee who has to accept the warning. And that there's always times is that you could have good warners, but if the warnee doesn't accept it, then you're going to have a bigger problem later on. And when you have a disconnect between warners and warnees, that's when you're going to have trends in price. So now, it's not something that I can incorporate in a model, but you should just think about that when you think about why do prices move in a certain direction, or what do we have when we look at different crises, whether it's banking crisis or debt ceiling crisis. You have the warners are saying, okay, here's the event. Then they'll talk about what's the likelihood. Then they'll talk about the severity. Then they'll talk about when is it going to occur. Okay, so it's likelihood, severity, and timing are what you always want to get right as a forecaster or a warner. But then first is that the warnee will sort of say, I don't really think that that's likely. So they discount the likelihood. Then they'll say, well, I think that this is going to be very severe. They'll say, I don't really think it's that bad. Then finally is this timing. When will it happen? You'd say, like, well, the warner could say, like, this is very imminent, and a warnee might sort of say, I don't really agree. You're just a Cassandra. So what I'm going to say, it's not going to happen immediately. It's going to happen sometimes in the past. And that disconnect is where we see that could be points of dislocation, which could then cause change, and it's going to cause price trends, because it's going to take a while for the warner to affect the warnee. So think about that in terms of the banking crisis. We probably knew pretty well what was happening with, some of these banks that were that blew up back in the fourth quarter. We knew exactly how much security risk that they were holding. So they're already being warned. They were told that this is likelihood. We knew that this is going to be eventual. We may not have known, or we may have disputed the severity, but let's say that the supervisors were telling us we had bank risks. Whether it's the Fed of San Francisco or the Board of Governors, they weren't really accepting that. Of course, the solution is that for all of that is that let's put on more regulation, as opposed to let's just be more effective at what we already know. But I think think of that in terms of warner versus warnee, to sort of say, why was there going to be dislocations in market, and why does it take a while for markets to adjust? So why our markets are not always efficient is because there's that disconnect between it takes two to respond to a crisis.
Do you think the same could be said at the moment about the de-dollarization? You definitely have people warning about it, but I'm not so sure the warnee receives that message or agrees with it, or is that a bit of a too much of a stretch?
No, I think that de-dollarization and all of these are this is we always want to talk about this systematic and trends that might exist, we always got to understand what causes those trends, or what could be leading to trends, because you constantly have people who sort of say, well, markets are fairly efficient, trends are being taken out fairly quickly. How can you still make money given all of our level of sophistication, by following trends? This is an age-old problem, and this always is going to exist. You say, like, de-dollarization. Is it likely? Not in the immediate, 3 months. So from a timing perspective, we're not going to have de-dollarization in the next 3 or 6 months. But we say, is it more likely if, let's say that, U.S. hegemony is less and people become more polarized? When you think about, what we've done with sanctions with the U.S. dollars, if people feel as though that there's always the threat of sanctions, then they're going to say, well, I got to look at some alternative ways to be able to invoice and make payments of my trade. For better or for worse, it's not a value judgment. It just is a reality. You say, what's the severity? Well, we're still fairly dollar denominated. Is that this is not going to change overnight. But does the fact that we're going to start invoicing trade in other currencies, is that going to start to have an impact on decoupling trade with the dollar? And the answer is yes. And we do know that. Why is the dollar so important, even from a trend follower's perspective? Is that if the price of the dollar goes up, and most commodities are priced in dollars and invoiced in dollars, it's going to have an impact on commodity demand. And so there is a spillover effect in the commodities markets in terms of being, again, macro aware. This is that if we see that the dollar was very strong, that's going to have an impact on demand for commodities. Now that the dollar is down 12%, we'll sort of say that's going to have a different impact on commodities. We have to be aware of those relationships. But it's not going to change in the near term to dollarization.
So as we've been talking about this, Mark, it kind of sounds like that you have a warner. The warnee may not pay attention, and so there's a bit of a surprise when it does happen. But I imagine that there's also this issue where there's a lot of warnings out there, and quite a few of them never come to pass. Nothing happens. So, I mean, again, how do we think about that? How do we deal with this? Because the other thing I really like about price as the input to a trading methodology is there's just one of them, right? So there's no debate. A lot of these other economic indicators and so on and so forth, they don't necessarily agree, and they give you different indications and signals, and which one should I trust and which one should I discard, and then you have this thing about people warning about, or not necessarily people, but things looking like something drastic will happen, then it never happened. So how does that play into your thinking?
Well, when you think about it, is what is price? The price is the arbiter between the warner and the warnee. So in some sense, this is it, or it's displaying what is the tension between the two. So a perfect example would be is if prices aren't reacting to a debt ceiling crisis, what we're saying is that the warners are saying we're going to have a debt ceiling problem. This should be embedded in price. This is that the warnees are saying, like, no, I'm not really worried about it that much. So what's the arbiters? They say, like, well, let's look at the price. Prices don't seem like they're reacting at this particular point. This is that they're saying there's a crisis, but we're not saying that this is an issue just yet. So it could be, or it will be, but not yet. So ultimately is that I think that when for our discussion purposes, I want to say you want to be aware of this, but at the end of the day is that the price ultimately is the place where we're going to sort of say where warners and warnees meet, and we'll sort of say which one dominates at a given time, or what is going to be the balance between the warning of a catastrophe versus the fact that we're going to look beyond it. It's price. So,
but to me, that just brings us back to price in the sense that that's all we need. I mean, I literally believe that from having started my career without rules, on the quote unquote discretionary side. But then once I discovered rules and once I discovered that price is so powerful, but to me, yes, there are lots of other things we could look at. But I think it is more confusing to try and make sense of these other things, because even if you're right about that the debt ceiling is an issue, we don't know when, and we frankly don't know exactly how markets are going to react. Are treasuries going to be the place people seek safety? Even though that might sound silly if they're going to default, but who knows? Or is that where they're going to dump dump the bonds? So I have to say, I mean, I'm still not convinced that I need to look much further than price.
Well, there's no question is that as we've always said, price is primal. So we've said this I've said this in this podcast. So we start as our null hypothesis, or where we start from is that price is primal. Now the question is constantly is that are there ways or are there things that we could do to give us a little bit of an edge beyond the idea that price is primal? Is there some things that could sort of say that can we avoid potential blowups? Can we be able to sort of see whether markets are overextended, where the likelihood that that prices are going to reverse are much higher than the likelihood of them going higher? Okay, so in some sense, this is that you say, well, what do you do as a systematic investor, as a researcher? What do you spend your time on? So we'll sort of say the holy grail is to try to find those indicators, those change points that use some awareness about what's happening in other markets or what's happening in the macro to give you a little bit of edge to say, if I'm saying that price is primal, we do know that once the market wakes up to a change, that it can change fairly rapidly, that the crowd will change and that there could be a rapid adjustment. And so you're constantly saying is that if only just a couple times a year or if for a couple events I could create a little bit of an edge in my favor, could that distinguish me from my peer group that is often doing some of the things that are very similar?
Yeah. And I will say that thinking about it as I hear you speak, I mean, there's one thing that sort of springs to mind to me where I think that maybe this could be useful. And that's actually flows. That's kind of capital flows, meaning, because price, the price may not go down, say, on any particular day. But if you notice that there is just so many more sellers. I mean, I don't look at the commitment of traders report, but I know that a lot of some people refer to that. But the idea of noticing how investors are changing or voting with their feet, I certainly wouldn't rule out that there is some value in that you may be able to extract. So I'm more in that camp where you can kind of tie it into an action that you can see in the markets, whether it's volume or something like that, rather than an indicator. But I want to make sure we get through all of your points before we run out of time. So,
but I think that you really do make a good point in terms of you say, well, we talked about what not to use. So, for example, we sort of said like revisions of unemployment numbers. So there are other areas is that what should you use? So commitment of traders, I think, is very useful. Most of the time, it really doesn't tell you much. Okay,
and sometimes it doesn't come out for 3 weeks.
There's the delay issues, but you'd say like we do know that if certain groups of traders are positioned at one side of the market and you get to an extreme, that crowd, that means is that from a awareness or change point detection view is that if a crowd is poised on one side of the market versus another, then we'll say the likelihood that a small change in expectations will tilt the balance and cause people to go the other way. The other thing we do know that flow and volume does tell us about, sort of whether, people are changing expectations, whether there's more uncertainty, because in some sense is that if you have more volume, then that means you have more buyers and sellers, coming to market with difference of opinions. So more volume is telling us, well, there's more uncertainty here because I got more people who want to say whatever position I had yesterday, I'm going to make a change to my position today, and so that is telling us that there's some uncertainty that's being resolved. What's going on in the longer term? You say, well, if there's flow of money coming in, whether it's if you look at flow of buying of ETFs, if you look at flow into certain asset classes, that is telling you is that okay, if there's flows with price action, that might be something that's telling us is that there's an enhancement of what's going on. So this is an area which is actually, it could be trend or price reinforcing, or it could also tell us what's the direction of the crowd. And the crowd all of a sudden could say, we could say that price is primal, but at the same time, the crowd will give us an indication of whether we're overbought or oversold.
The last few points in your list, I see some things about machine learning, maybe scalability, inflation, growth cycles.
So I will sort of say that there has been, the buzzword is everybody's got to use machine learning, and I probably would sort of say that I've had to re-educate myself, but I sort of increase my my awareness. We'll talked about macro, micro awareness. Like I say technique awareness is also important too. Is that should I be using this? Should I be looking at this? And in some senses, is that the answer is yes. But sometimes these techniques is that are they really going to add a lot of value? I think that I'm still making my judgment is out on some of it. But what I wanted to try to talk to you about this is why do we need machine learning? And I'll take it at a very high level is that most of the statistic work we do is using regression. So it may not be from a trend follower perspective, but generally it's going to be based on regression. And regression is very linear, okay? But I'm trying to fit a line through a set of data points, okay? The one thing that we've learned, if you trade markets for a very long time, is that markets are very nonlinear, okay? So they don't behave in a straight line. So a trend line is not a linear line. Trends can be very nonlinear in behavior. So a perfect example is that there are a number of traders who often used back from the 80s and even probably still currently is breakout systems. A breakout system is a nonlinear system. It's saying is that okay, if I don't trade if the prices are within a range. But if it moves beyond this, the high of from some period in the past, then it breaks out of that range. I'm now going to take a position. That by definition, any trend person or systematic traders that uses that type of model is thinking about markets in a nonlinear fashion. And so what is machine learning getting at is that, and one of the things I think it's trying to focus on is to say, what happens if the world is nonlinear? What happens if I can't just fit a line through this? That there's more complexities in how prices behave in the past that I can extrapolate into the future, the information that I might use from other sources to be able to determine or forecast in the future. And I think that we could think in terms of nonlinearities. So from a listener's perspective, what you want to try to say is that, do I have a model that can account for the fact that markets are nonlinear? Or how do I sort of capture nonlinearity in markets? And I think that that's what I want to try to, we should often focus in on.
Yeah, which, and I don't know if we made that clear, but I mean, that's obviously one of the advantages we believe trend following has, is that we participate in some of these silly price movements that no one can really fathom can happen. Like when bonds were coming down in terms of yield at 2%, people were saying, well, clearly they can't go any lower. And they just kept going and ended up negative in Europe, of course. And oil prices going negative a couple of years ago.
Well, the other area where when you think about machine learning or unsupervised learning, because you're supervised and unsupervised learning, is that it's sort of saying, let the data speak for itself. In some senses, that's the mantra of machine learning. And I think the same applies for very traditional trend following. This is that a trend follower doesn't impose that one market is going to have to behave a certain way if another market does the same thing. So you don't try to sort of impose a model upon prices. So let's take, for example, if you were trading a number, 2s, 5s, 10s, and 30s, on the treasuries. This is that, one way that if you did your principal components analysis, you look at this, it will say that the yield curve usually moves up, parallel fashion. So all markets should be the same. So a trend follower said, no, I'm going to look at the 2s, 5s, 10s, and 30s as each in an individual market, and I'm going to let that price trend speak for itself. And so it's possible that I could have, prices where I'm short the front end and I'm long the long end, but I'm not, because I've imposed a view on the yield curve. It's just say, this is what prices tell me. So in some sense, I'm looking at this as each market uniquely. I'm not imposing a model upon it. I'm doing this on an unsupervised basis. And in some sense, those are some of the things that a machine learning was looking at. Is say, I'm going to look for relationships that may or may not exist based on past data.
Anything else, Mark, that you want to educate us about today when it comes to change points and some of the work you guys do and look at?
Well, the one thing I'm going to come back to in our next is sort of the intangibles of quant trading versus discretionary. And we sort of, and I want to come back to this person, Sherman Kent. And I'll leave this as almost as like a teaser for the next time we talk. So one of the things that he did is that when you had these CIA analysts say, and they'd give their assessment, they'd often use words. And they'd sort of say, well, some event was probably not going to happen. And so if I said something, it's probably not going to happen, what would you sort of give that if you actually had to give it a probability? What probability would you give that to?
Probably 20% or less, right?
Yeah.
That it was going to happen.
We'll sort of say that so there have been people who have looked at this, they call words of estimative probability. And they say, well, if we survey, what do a group of people think they heard when they said that? And that's probably about 25% as a probably not. But the range was actually between 50% and 0. So if you sort of say, we believe, what do you think the probability of, when I say we believe that rates are going to go up, what would you give that as a probability?
I would say 70% plus.
You're pretty good. This is that it's about 75, but again, the range was between 40% and 100% when someone says that. So let's go back to where we talked about is price is primal. This is that, if some analyst is or if you're in an investment committee and someone say, well, we believe interest rates are going up, that you can have a big range of opinions on what that means. Okay, but when you look at a trend following model, if you look at prices, you say, well, what do you really believe? Well, I believe that, past prices have been going higher. That's what it tells me right now. So my best guess is that they will continue to go higher in the next period going forward. That's what a trend follower will do. That's the way he looks at that. So,
and then on top of that, Mark, it's a good point you make there. I would say for those who may not be sort of in the nitty-gritty of how we do things, if you think about a trend following model and, some models like the ones that I work with, I mean, we will have hundreds of smaller subsets of quote unquote confirmations we need to build up the full picture of the strength of the trend we believe. So essentially, if you just took it as a simple scale from 0 to 100, anything above 0, you're long, and at 100, you're fully long. So on any one given day, our trend strength in a market will be, 50% or 55 or 57 or 63, whatever. And what I like about it is that it actually then incorporates, quote unquote, the probability of how strong the model believe in that the price trend will continue. Because if it didn't believe in it, so to speak, it would probably have a relatively low trend strength, right? But if it is at 100, so all these sub signals are pointing in the same direction, you could say on that day at least the conviction or the probability of that trend continuing is pretty strong in the model. So that's what I like about it. It's
You really focus it on the number one point is, don't ask my opinion. Show me what positions you have in the marketplace. So you can't sort of say, if you say like, well, I really believe gold is going higher. No, show me whether you're long gold and tell me how big that long gold position is vis-a-vis everything else you hold, period.
And that's another great point, Mark, because I remembered about a year ago that I was picking up from people attending conferences with big hedge fund managers that a lot of them were very bearish, correctly. However, when they were then asked, so what's your position? A lot of them were just saying, well, we're in cash, right? So they weren't short bonds to a large extent. They weren't short equities to a large extent. They were just in cash. So I think it's a very, very important point, this thing about, yeah, we can have our beliefs, but if we're not willing to put the money, our money where our mouth is, it means nothing. And I think this is generally, and this is, it's a criticism, of course, but, it's not a personal criticism, but when you see a lot of quote unquote experts coming on CNBC and Bloomberg and all of that, these are people who have no positions. The good ones will have positions and they will be worth listening to. But most of them, economists, strategists, whatever they're called, they have no position in the market. And if they did, it's not their own money, right? So this is why I really discount any value in a lot of this. Anyways, I'm obviously preaching to the choir here, but I think that those points are really important, and that's why I have such great faith in the continuation of trend following as a strategy that will always add value. And I think I want to do more. I know there's a paper that came out, again, just confirming some of the things we've talked about, but I'm going to read up on it and maybe bring it up next week or the week after with one of the other guys. But anyways, this has been fascinating, Mark. Any final thoughts on the topic, or are you going to keep that as a teaser for next month?
We'll keep that as a teaser. And I think one of the other things we want to come back to is a little bit about, skew. And I think that some people have done it. Quantica has done some interesting work in where you look at this, is that like a trend follower can have negative skew in the very short run. Okay, you have a crisis. Is it like, okay, I get blown up, but then in the longer run, is it as a crisis actually works its way through? This is that, and if you look at a longer horizon, a trend follower can have positive skew, because oftentimes they'll hang on to trends longer than other people. They'll often get out of stuff quicker, or they'll either get out themselves or involuntarily with stops. And so you get this negative skew in the very short run. But in the long run, you get this positive skew because you're going to get on these trends and you're going to stick with it. So that when we talked about that again, then inertia, you say, especially if longer term, the inertia will sort of give you positive skew if you can hang on. And if, let's say, some events work itself out, what we talked about is that these crises are unaddressed as opposed to unforeseen. This is that creates positive skew. And so I think that that's something we should also talk about, because I really think that that's a interesting dynamic that you may not see in other strategies that's relevant.
Yeah, no, I agree with that. I have not yet read the paper from Quantica, but I'm definitely going to catch up on that. And it ties kind of nicely into what Alan and I talked about last week, this Mikita paper, where they divide some of these risk mitigation strategies into different categories, like first responders, second responders, and diversifiers. And the second responder category, where trend following falls into, you kind of really feel, the importance of that category. Even if you want to try and sort of just put it to a normal analogy of an emergency, a medical emergency, sure, a first responder is very important and can do stuff, but they can't keep the patient alive for very long. You need the part of the emergency team that has the equipment and can stay there for a long time. And I speak from personal experience, as most of the listeners will know, that second responders are incredibly important as well. So anyways, this was fascinating, Mark. I truly enjoyed it. And obviously, I fully understand why this is a topic that you're really diving into with your colleagues at the moment. So go and check that out. Mark's new outfit. You can obviously find the link and follow Mark in the show notes. And if you like these conversations that we put out every week, we would be ever so grateful if you would go and rate and review them on iTunes, Spotify, Amazon, wherever you listen to podcasts. We certainly would love that. And of course, if you wouldn't mind, take a few minutes of your time and maybe share a link. You can share a link called toptradersunplugged.com/share. If you send that to your friends and colleagues or anyone who's interested in investing, global macro, what's going on in the world, hopefully they'll find a safe space here at Top Traders Unplugged. Next week, Jim is back on the podcast. Not that he hasn't been back, but on the Systematic Investor series. So we're going to have a chat about what's going on in the vol space, I think, and other things. So send in your questions to info@toptradersunplugged.com, and I'll do my best to get an answer from you. I think that's all for today. A couple of big events also happening today, Mark. Warren Buffett is holding his court, and there's a certain King Charles that is also holding his court and getting a crown on his head as we speak. So lots of things to dive into, I'm sure. But any event, we appreciate people coming here, listening to us every week. So from Mark and me, thanks ever so much for listening. We look forward to being back with you next week. And until next time, take care of yourself and take care of each other.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.